Good day, everyone. My name is Juliet Pumpuni. I'm a senior energy specialist at the World Bank. And welcome to the launch of the Designing of Public Funding Mechanisms in the Off-Gris Solar Sector report. So before we start, let me quickly go through a couple of housekeeping rules. I would kindly ask all attendees to be on mute when you're not speaking. And I would encourage you all to use the chat function when you have a question to ask or to make a comment. I'll pick from those questions during the Q&A session. This event is going to be recorded so that we can share it with people who were unable to attend today. And so the recording has already started, so now we can begin. Panelists, I'll be keeping an eye on the time so that we can go through this whole thing as quickly as possible, because I know the Q&A is going to be a very interesting session. So I'll quickly go through the agenda. So I will start with introductions. I'll do a quick introduction of the webinar, and then it'll be followed by a presentation by Charlie Miller. He will make the case for public funding in the off-grid solar sector, the funding needs of the sector, outline the necessary or critical steps to follow for designing a public funding program, and the various funding mechanisms that are available. And he will just share the conclusions and recommendations from the report. And following that, there'll be a panel discussion with 4 experts in the field, and this will be followed by the Q&A session. So now we can go to the introduction slide. So the question everybody would ask is why we undertook to do this report. There was increased interest from the World Bank teams, government counterparts, and the wider sector in designing public funding mechanisms in the off-grid solar sector. And ESMAP was being asked a lot of advice and support in this area. So while there are many publications that focus on 1 or 2 mechanisms, few provide the overview of all the main mechanisms and a comparison of them. Collectively, the energy access community has gained a lot of experience using public funding for off-grid solar in recent years, and we wanted to capture, synthesize, and share lessons from these recent experiences. So the report contains these basic elements. It aims to guide governments and their development partners on how public funding can be used to provide energy access through off-grid solar solutions and share lessons on how funding mechanisms can be designed and implemented. It focuses on domestic solar solutions such as solar lights, SHS, and related appliances. There are both supply side and demand side funding mechanisms. The supply side are related to funding companies and investors to minimize risk and the cost of supplying products. And the demand side is to reduce the cost for the end user. Funding mechanisms reviewed in the report include upfront grants, RBF, tax exemptions, credit lines, etc. The report was a result of an extensive desk research and stakeholder consultation. Our hope is that it will be a useful resource for governments, the World Bank teams, and other program implementers in the sector, as they consider the best way to use public funding to provide energy access to households through off-grid solar solutions. So with this introduction, I hope I have whetted your appetite for the main presentation for today's event. Let me introduce Charlie Miller, who will be presenting the report. Charlie is an energy specialist consultant who has been working with the ESMAP Lighting Global team since 2018. He's an off-grid solar policy and public funding specialist with deep experience of supporting government, private sector, and finance stakeholders in Africa to work together more effectively. He also works as an advisor to the Global Distributors Collective and the Energy Saving Trust on a range of market development, public funding, and policy initiatives. So Charlie, over to you to take us through this reports. Thank you.
Thank you very much, Juliet. I'm very pleased to share this report, which has been in development for quite some time now. We worked with Economic Consulting Associates and with African Solar Designs to undertake extensive stakeholder consultation. I would say that we looked at probably around 50 different programs, some led by governments, others led by aid agencies and foundations, working to deliver energy access through household off-grid solar. And what we were really trying to do is to pull together that overview, that big picture that Julia mentioned at the outset. But before we go into the mechanisms themselves, I think it's worth restating what is the rationale for using public funding to achieve energy access through off-grid solar. I think we really see that there are sort of three key elements to this. The first is that the off-grid solar sector is a credible, fast and cost-effective way to achieve access. As many on the call will know, the sector is already serving at least 420 million users. And lots of geospatial planning and lease cost planning exercises have shown that off-grid solar is the fastest and most cost-effective way to reach a significant proportion of the population, primarily those on lower incomes in more remote rural areas where extending the grid is challenging because of the high cost and the time required to do so. Another key element of the case for public funding for off-grid solar is around leveraging private sector capacity and co-investment. Off-grid solar companies are now present in pretty much all the countries that have a significant energy access deficit to some extent. There are many nascent markets out there, but even in those more nascent markets, you will see that basic solar lights are available in the major cities, and there is a market to work with and to build on. Related to that, governments obviously have very scarce public funding to deploy in support of their energy access goals, and being able to attract private co-investment is really essential to unlocking the level of overall investment that the sector needs to succeed. So that's a major attraction for governments, I think, is being able to co-invest with the private sector and to leverage that private sector investment. Finally, using public funding in the off-grid solar sector is an opportunity to promote quality and to protect consumers. I think sometimes we tend to forget that most of the market still is made up of non-verified products of variable quality, and those products being sold for cash are the only option available to a lot of people if they don't want to use kerosene, batteries, or candles for lighting. So public funding for the off-grid solar sector can help to drive adoption of quality verified products that deliver a higher level of service and that are just a better investment for customers, that are going to deliver a much greater benefit to them in their lives. And probably one of the most exciting trends in this area, as many will be aware, but it's worth restating, is pay-as-you-go. Pay-as-you-go is a business model that enables people to pay for products over time, and is really the driving force behind a lot of the private investment that has come into the off-grid solar sector over the last few years. But I think another really important impact that pay-as-you-go has had is driving up the average level of service that customers are able to access. We see a steadily increasing proportion of off-grid solar customers able to access tier 1 under the multi-tier framework or above. I mean, the proportion that is at tier 2 or above is also growing steadily thanks to pay-as-you-go and innovation around being able to pay over time to overcome those high upfront costs. I think the other really important bit of context for this work is the funding needs of the off-grid solar sector as a whole. When you look across all the different business models that are out there, they're extremely varied. You have vertically integrated businesses that do everything. You have unbundled value chains where there are distributors and manufacturers working together. with service providers and consumer financing providers sometimes playing distinct roles as well. So a lot of specialization. And those different kinds of companies have different capital needs. Obviously, with pay-as-you-go, because you're providing consumer financing to a customer, you need to wait a lot longer before you can reach gross profitability, a gross margin. And so the working capital needs of that model are particularly intense. But even with cash sales, there's a significant time lag between ordering stock, waiting 3 months for it to arrive by sea, and then being able to distribute it within the country and sell it. So all companies have significant working capital needs, but pay-as-you-go has more pronounced, it's more capital intensive business model. I guess the other thing I would highlight here is that not all off-grid solar companies are pursuing rapid scale. I think this is something that we're increasingly aware of these days, thanks to research from the Global Distributors Collective, which perhaps Emma can touch on later. And we see that all companies need working capital, but that those companies that are pursuing a fast growth path have much more significant equity needs in order to drive that growth. And the research from the GDC has revealed that with smaller companies, especially the ones that choose to stay small and pursue that kind of low risk, low growth trajectory, that they are much more reliant on working capital and grants and friends and family equity to be able to maintain their operations, and not so reliant on external equity. So that's kind of an interesting thing to consider. I mean, this relates to public funding because the public funding mechanisms that we're going to describe can help to address some of the off-grid solar companies' financing needs, but not necessarily all of them. And I think whenever you're designing a public funding mechanism, the most important thing is to keep in mind the broader financing situation of those companies. So for example, to avoid a situation where an upfront grant program or a results-based financing program is constrained because companies lack access to working capital, or correspondingly uptake on a working capital facility might be limited because companies don't have access to the equity that they need to build out their distribution capability. So I think the last sort of scene setting slide, if you like, we just wanted to do a sort of stock take of the steps that governments and their development partners should be taking when designing a public funding program. And we thought a good place to start would always be the National Electrification Strategy, to check whether off-grid solar is integrated into the National Electrification Plan. As of 2018, the last market trend report, we saw that a good 70 countries do have off-grid solar integrated into their plans now, which is a tremendous achievement. But I think we are still in the process of figuring out exactly how those off-grid solar components interface with investments on the grid side, and how we make the whole more than the sum of its parts. Related to that, we also felt that it was really important to understand what's going on the demand side. So multi-tier framework surveys can come in, and they can help you understand, what people are currently using as a source of energy, and what the nature of that energy access is in terms of quantity, quality, availability, etc. Those multi-tier surveys can be really helpful when you're trying to look at affordability and making sure that the solutions that you're promoting for your program are in line with capacity and willingness to pay, but also, potential future growth in people's energy needs. Neither of those exercises is a substitute for an in-depth off-grid solar market assessment, which I think we see as absolutely kind of crucial. The more we look at the off-grid solar sector in different countries, I think the more struck we are by how unique they are and how different they all are. So undertaking that deep dive into what the sector looks like in a particular country is really, really important. And not just looking at, what the companies are like or what the customers are like, but also trying to understand who the government agencies are, who the aid agencies are, and the programs that are supporting the sector, trying to get a sense of what they're currently doing and their future plans, but also making an assessment of their capacity. So for example, if you're exploring the viability of a tax exemption, you might be interested in looking at the National Standards Laboratory, the customs authorities or the revenue authorities to understand what it would take for them to be able to introduce and maintain a tax exemption. So I guess that links to the next issue, which is we also need to consider very carefully the implementing mechanism for these programs and to make sure that the implementation mechanism suits the funding mechanism. Generally speaking, with government-led projects financed with the World Bank support, the lead agency would be a rural electrification agency or a Ministry of Energy, they may or may not have the capacity and the partnerships that they need to deliver the program, but it's really important to source the expertise and the skills and the experience needed to be able to implement these mechanisms. And ideally, all the implementing partners should have deep knowledge of the off-grid solar sector and the country context. But quite often it's these sort of perfect partners are not available. And so it's a question of pulling together the right partners into a consortium to work together and building those skills and capabilities and experiences where they're currently missing. And finally, just to consider that there's more to support in the off-grid solar sector than how you use public funding. Complementary interventions might be needed in areas such as consumer awareness, technical assistance and capacity building, not just for the private sector, but also government and investors, as well as regular market intelligence studies to maintain a live understanding of the situation. So Rogate, for example, in West Africa includes all of those components. Moving to the next slide. So when we looked at, when the different funding mechanisms might be suitable, we identified some kind of classic cases where a particular mechanism might be appropriate. For upfront grants, we felt that they would be particularly useful where you have young and innovative companies that lack track record to attract investment, or perhaps you're seeking to incentivize new companies to enter an established market. For results-based financing, it may be that high costs and risks are preventing companies from entering an underserved location, or there's a private sector that's there, like for example in Kenya, but that needs to rapidly scale up and to reach people or geographical locations that it's not currently serving. With tax exemptions, we felt that it needs to be really important to the government to support the off-grid solar sector because there's a need to maintain those tax exemptions over time. So that commitment from the government is essential. But affordability is a major barrier to growth. So tax exemptions can play a role in that kind of setting. I think another really interesting thing that tax exemptions can do is they can help to bring the cost of quality verified solar more into line with the cost of non-verified products. And that can help to promote uptake of quality products in a country. With credit lines, I think that we see this mechanism as being appropriate if banks lack liquidity to invest in the off-grid solar sector. They may have the appetite for risk, they may be prepared to invest, but lack the liquidity to do so, in which case a credit line can provide them with financing that they can then on-lend. Risk mitigation instruments are looking at the same issue the other way around. It may be that the banks have liquidity, they have money that they can invest, but they're not prepared to do so because of the risk, or because their procedures, their regulations prevent them from doing so. In particular, their rules around what kind of collateral they can accept. So risk mitigation instruments such as guarantees can be used to share the risk between the investor and the public funding provider in order for those investors to be able to take risks that they wouldn't otherwise be able to take. And quite often we see credit lines and risk mitigation instruments combined because both liquidity and risk appetite are challenges. Moving over to the demand side, we do see a need for demand side subsidy to help address affordability challenges in situations where households are unable to afford off-grid solar products. But I think there's a lot to be said about the sequencing of the different mechanisms and the ways in which they can be combined, which will help to understand the role that we see demand side subsidies playing in supporting off-grid solar market growth. And finally, public procurement. Public procurement has played a very important role especially in Latin America and in some Southeast Asian countries, where a market-based solution was not viable because target populations are too poor, too remote, too few, or too dispersed to be able to serve them with a classic market-based solution. So this slide, which you may have seen before if you've attended any of our recent End User Subsidy Lab webinars, I think gives a really nice overview of the relationship between supply and demand side levers and how both can be used to close gaps in terms of the high cost of distribution, but also in terms of limited willingness to pay or ability to pay. So generally speaking, we would encourage those involved in program design to think about what can be done on the supply side first in terms of supporting technology innovation, in terms of providing funding to companies to help overcome high distribution costs and risks, and to look at what can be done to create a more enabling business environment, whilst in parallel also considering what can be done on the demand side to increase awareness and appetite to purchase quality products, but also to overcome affordability challenges through making consumer financing available, particularly through pay-as-you-go. And these kinds of measures can help to reduce the gap that then needs to be filled through end user subsidy. And I think it's worth noting that this is not just a sort of a straight left to right spectrum that we have here. The IDCOL program was quite interesting because IDCOL had an end user price subsidy at the beginning, but over the 20 years of its operation, the cost of technology came down, which meant that they were able to phase out that end user subsidy over time. So you may see that there's a need at one time, but that need changes as a result of changes in the context. And I think that speaks to one of our kind of key messages coming out of the paper, which is maintaining a live understanding of what's going on and being prepared to adapt accordingly. So to summarize so far, we think that a holistic approach is generally needed that combines more than one public funding mechanism with other interventions as well. If markets are nascent, then generally speaking, upfront grants or results-based financing or a combination of the two can be a good solution. And if companies lack access to working capital financing but are otherwise close to meeting lender requirements, then credit lines and risk mitigation can be considered. But we have seen, as I will explain in a bit more detail later on, situations where even with credit lines and risk mitigation instruments in place, lenders remain reluctant to lend and companies remain too far from meeting requirements. So they need to be quite close together in order for these instruments to be able to bridge the gap. In settings where risks are already high and affordability is low, the provision of demand-side subsidies from the outset can work well. So we used this for example, in our Yemen project, where we were trying to persuade some MFIs to engage with smaller scale off-grid solar products than they had worked with in the past, and to go into rural areas that they were not currently serving. And we knew that there was an affordability issue as well. So faced with that array of high distribution costs and risks and affordability challenges, we introduced a demand-side subsidy from the outset, and that enabled those MFIs to build their capacity and experience to get more comfortable working with those products and those customers and those locations. And over time, we've actually been able to transition to a more conventional RBF approach because we help them overcome that particularly high costs and risks that they faced at the outset. And then, of course, in situations where market-based solutions are not viable, a public procurement approach can be used. So just to very quickly run through some of the advantages and disadvantages that we identified for the different mechanisms. We see upfront grants as playing a particularly important role in nascent markets, helping businesses develop a track record and get investment ready. Often that is most effectively done when combined with capacity building support or repayable grants on the working capital side, which is something that AECF has been a pioneer of, and perhaps Victoria can touch upon a little further later in the panel. But some of the challenges are around, for example, generally only working with a handful of companies and giving them an advantage over others. If you want to support the whole market, then you end up with higher transaction costs, and it can be quite kind of challenging. And then I think also the grants may not be large enough or long enough to enable companies to access private capital. And we tend to think that, you give them one grant and then they'll be investment ready, and it just doesn't work like that. We need a very kind of long-term mindset and recognize that markets and individual firms have a long runway in order to reach commercial viability, and need to be supported on that journey. And it's not a quick fix. Over on results-based financing, I think this is kind of a wonderful kind of multi-purpose tool in the toolbox that has been developed over the last 15 years or so in the off-grid solar sector, that can be used to incentivize companies to enter a new area or to address financial bottlenecks along the value chain. So for example, we've seen RBFs that provide financing to distributors, or that provide funding to support bulk procurement in the case of the Global LEAP program. One of the key advantages is that the delivery risk lies with the company rather than with the grant maker. But I think, the expert agencies in this sector recognize that it's not a complete solution in its own right. It may not always be appropriate for more basic products that are sold for cash, where the collection of customer contact details might be prohibitive. And determining the right amount of subsidy can be challenging. So there's a lot of thinking that needs to go into the design of RBF, and some pretty specialized kind of skills and capabilities that are required to deliver RBF effectively. So thinking about that implementation mechanism and the capacity of the agencies involved is really important. Moving over to tax exemptions, this is probably the funding mechanism that is most popular with the private sector because it very clearly has an impact on the company's bottom line. It enables them to bring products into the country at lower cost, and to be able to pass that cost saving on to end users in the form of lower prices, which is wonderful because, as I said, it helps to make quality verified products more cost competitive with non-quality products that are out there. I think one of the key challenges that we see with tax exemptions is they tend to be a bit unpredictable and unstable. We see in a number of countries where perhaps a new government comes in, or there is a change of policy, and all of a sudden all the tax exemptions are revoked. So I think a key theme here is around predictability and stability in the tax policy environment, enabling companies to have stable pricing strategies and to manage consumer expectations effectively. One thing I would emphasize here is that we have an increasing number of countries that now have mandatory quality standards in place. And that is presenting an opportunity to have quality linked tax exemptions really at scale in the sector for the first time. Excuse me. Moving over to credit lines. The advantage of credit lines is it enables financial institutions to select companies to invest in using their normal commercial process. And through doing so, to gain experience in the sector, to more accurately appraise risk, and to begin to participate in financing the sector for the long term. And I think some of the challenges there are around possibly crowding out commercial investment if not well designed. And in some cases, even if a credit line is in place, that may not be enough to get banks to invest in companies. And that may be because, as I say, it could be because of their risk appetite, it could be because of their rules and regulations around, for example, collateral, or it could be because the companies remain too small and lacking in the track record required to be good candidates for loans. So this is where I think risk mitigation instruments can also play a role. As I said, kind of risk sharing between commercial lenders and donors where risk perception is high, which may well be because actual risk is high, or it may be more to do with banks being unable to appraise risk accurately. Or it may be that the off-grid solar sector is very nascent, and it's not enough to get over the line. A number of our credit lines, even when providing risk mitigation as well, have struggled with limited uptake because of this issue that the companies and the banks were just too far apart, and those solutions were not sufficient to close the gap on their own. And I think what we're increasingly concluding is that in those situations, other mechanisms like RBF are needed to provide a more complete solution, financing solution to the companies, as well as more kind of technical support and business development support to the companies to help close that gap, that we can't rely on the credit lines and the risk mitigation to do it on their own. Demand side subsidies is a kind of a new funding mechanism that I think we're still building our sort of experience of. And there's a number of countries that want to experiment with this approach, most notably Rwanda, which Chiara can hopefully touch upon in her remarks. This approach does come with a high market distortion risk, especially if implemented in parallel with supply side mechanisms and attempts to build a commercial market. So those market distortion risks need to be considered very carefully. But I think you know, as the market grows and as we start working more and more on really quite remote locations and targeting poorer customer segments, the need for and the role for demand side subsidies is likely to grow. So figuring out effective ways to design these mechanisms is a key priority for the sector over the next few years. And finally, public procurement. So this is an appropriate solution for poor, remote or isolated communities, or indeed for humanitarian settings where market-based solutions are not viable. Centralized government purchasing of off-grid solar can significantly reduce costs through bulk procurement, and the mechanism can be used to reach quite large numbers of people quite quickly. It can be faster than a market-based approach. But it's expensive, that's one thing. There's a high cost per household served through this approach. And the complexity of implementing it effectively is a challenge as well. It does require that government agencies and their contractors have or are able to build the ability to do all the things the private sector normally does: distribution, installation, maintenance services over time. And because of the fact that those services need to be maintained over time, that comes at a cost, there is a need for a long-term source of public financing to ensure that need can be met. I think that could be very challenging for utilities in some African countries because the utility financiers are not able to bear those additional costs. But you know, just to take an example from Latin America, the Peruvian government was able to provide long-term financing for its off-grid solar electricity service delivery program through a cross subsidy. So in essence, marginally raising the tariffs paid by higher consuming customers in Lima and the other major cities was sufficient to cover the long-term costs of delivering access through off-grid solar in deep rural areas. So just to come to a close, the report finds that there is no one-size-fits-all public funding solution. Every country is very unique, and the solutions that are needed need to be tailored to country context. And also the markets change very quickly over time. You know, what is the situation now may be very different in even a year or two, let alone 5 years out. So really encouraging those involved in program design to build flexibility into the way they work, to target their efforts effectively as best they can, and to ensure proportionality in the use of public funding so that it is sufficient to overcome high costs and risks and to address affordability challenges and to enable the private sector to really play its huge potential role in the delivery of energy access without over-subsidizing companies or inefficiently using public funds. Related to that, I think we see an important point around efficient fund management. More and more programs are using software and sharing data directly across companies and government agencies to facilitate the efficient use of funds and try and minimize the bureaucracy involved in these programs and the time lag as well. I mean, I think things like being able to process claims quickly is really crucial if our objective is to help companies with managing their cash flow and making sure that they're not cash constrained at any point in a program. Verification of results is obviously essential. That can be particularly challenging in areas where people are changing their phone numbers quite frequently. But I think, again, this is an area where, you know, we need to innovate and we need to continue to be creative and look for better ways to do things that minimize the burden on companies participating in programs while still giving the providers of public funding confidence that their resources are being used efficiently and contributing to their overall objectives. And finally, sustainability. It's really, really important to think about a phase-out strategy for public funding mechanisms so that the market can stand on its own 2 feet. But I think we're mindful that that's not always possible with, for example, the demand-side subsidies or the public procurement mechanisms that are needed to reach particularly low-income or remote or isolated communities. And so in those situations, we recognize the need for long-term sources of public financing that can enable delivery of energy services to those groups and make sure that they're not left behind. So with that, I'd like to close. I'd just like to say a quick thank you again to Elena and Fede from Economic Consulting Associates, Mark Hankins from African Solar Design, and the wider team for their support in the stakeholder consultation, the analysis, and the content development. We hope this report proves useful to governments and their development partners as they figure out, and the wider sector, as they figure out how best to use public funding to achieve energy access through off-grid solar. And the report itself will be published in the next couple of weeks, and it will be circulated to everybody who has signed up to this webinar. So watch this space, it should be in your inboxes soon. Juliet, back to you.
Thank you so much, Charlie, for this comprehensive and interesting presentation of the report. I would invite all participants to put your questions in the chat box, or even during the next session, which is the panel discussion. You can raise your questions during that window of opportunity. Let me just make a quick note that even though governments are a key audience for the paper, there's no government representative on the panel today. As some of you may know, the Lighting Global team has been holding a series of webinars to explore country-level project case studies through the End User Subsidy Lab. With this webinar, we wanted to zoom out and focus more on what has been happening in the off-grid solar sector globally. So for that, we have 4 experts with experience in different funding mechanisms in multiple country contexts. So let me introduce this August panel that you see on your screen right now. So first we have Victoria. Victoria Sabula is the Chief Executive Officer of the Africa Enterprise Challenge Fund. The AECF is Africa's largest challenge fund that deploys patient capital, technical advice, market linkages, and advocates for private enterprises in the renewable energy, agriculture, and climate change adaptation and mitigation sectors. Next, I'll introduce Chiara Rogate, a senior energy specialist at the World Bank. She has designed and led off-grid credit lines and subsidy programs, including for productive uses in several countries in East Africa, as well as sector development engagements through regional integration and power trade, including an FCV context. Then I guess the next person was Christian Schattenmann. He's a fund manager at Bamboo Finance. Christian is in charge of energy access activities at Bamboo Capital Partners. Specializing in off-grid energy investments, he has led multiple equity and debt transactions in energy access companies. As Bamboo's head of energy access, Christian manages sector development funds in Haiti and Madagascar, which includes results-based financing grant programs to develop energy access markets. Last but not the least is Emma Colenbrander. Emma is the head of the Global Distributors Collective, a collective of over 150 last-mile distribution organizations operating worldwide, hosted by Practical Action. Emma is also a trustee at Ashton and is a co-founder and former executive director of Pollinate Group, an award-winning social enterprise. So now we're going to start the panel discussion. So let me start with you, Victoria. Participants, whilst we are having this discussion, you can still put in your chats in the chat box, your questions and comments. So Victoria, AECF, is a leading provider of upfront grants, interest-free loans, and technical assistance. Is there a story you can share which illustrates the benefits of supporting companies in this way, but also the risks and challenges involved?
Thank you, Juliet, and really great to see the panelists and also to have the participants join us today. Thank you, Charlie and team, for a really great job. So really, AECF was set up for the reason of really providing grants to private sector enterprises and de-risking for private sector investors. You asked me of an example of an investment that we have made using grants as a mechanism. And I would possibly do a disservice to this company that I did not first start with a country where they are presently operating. So let me speak about Liberia. We all are familiar about Liberia. It's a West African country. It's one of the poorest countries in the world, the seventh poorest as we speak today. Their budget for the year 2021-2022 is about $718 million total. 85% of it goes to recurrent expenditure, with only about 15% going into CapEx. It's the most rainy, one of the most rainy or wet countries in the world, making it so difficult to access some of the very rural regions in the country. 51% of the population lives below the poverty line, with a number of households actually under $2 and some under $5 a day. When you go to rural Liberia, I feel like you feel the poverty level. Like you cannot run away from the fact that these communities are marginalized and they struggle on an everyday basis. Then you look and say, what private sector company will actually choose to risk their capital to come and invest to be able to reach these communities with energy that they so need if their lives is going to be different years to come. So I then want to share with you the story of LIB Solar. LIB Solar is an off-grid solar company that specifically distributes solar products. They have nanogrids and solar home systems, and they use the pay-as-you-go model. LIB Solar saw an opportunity in rural Liberia. They specifically actually looked at how the community was organized and how so close-knit the community was. And they came together to raise, resources for whatever need arose. And they thought there is definitely potential for this community to be able to pay for, an energy service, and they so much need the energy. And so they came to the AECF at a time when we were running a competition, which is under our Renewable Energy and Adaptive Climate Technologies program, and we supported them with grant funding of $850,000. And we really were seeking to de-risk for them to go to a southeast region, which for anyone of you who knows Liberia, once it rains, you don't access the city for like 4 months. And they really needed to be a model that would be able to fit how the community structures are set. More than half of LIB Solar's customers live under $2 a day. And so everyone would say, how would these people actually be able to pay? And they had a product that they could be able to provide to the community at $8 per month. And they accessed the funding. They have so far been able to expand their operations to the southeast region. They have reached 18,000 households against an earlier target of 10,000. That is 90,000 people. Out of actually these 90,000, 72% of them live below the poverty line. And despite actually their low income, these households are proving to be good customers, and they are a source of sustainable business for LIB Solar. Approximately 85% of these customers make their payments each month. But you see, you would disregard them. You would disregard them because they are very poor. You would disregard them because there is absolutely a lack of infrastructure to be able to access their region. But there was a private sector enterprise that are willing to take the risk, but no commercial investor would actually dare risk their money because they are looking at financial returns. And they needed a vehicle such as the AECF that would actually be able to offer funding that is more oriented towards social impact. The AECF funding actually de-risked for follow-on investors, and the company has since raised more than $3 million from other sources to fuel their growth. And really, this is what public funding is about. It's just de-risking for private sector investors and being able to support the mobilization of further capital to places where it is really needed. It is really for purposes of saying how can market systems work for the poor? How can we get private sector benefits to persons who for no reason of their own are marginalized? So that's really the case example that I can be able to share. There are so many examples in our portfolio, and if you're ever so eager to get to learn about how grant funding is actually shifting chances for rural and poor communities, please come and speak to us. We have about 175 companies, off-grid companies, that we have so far financed. When you think about the growth of the off-grid solar market in Sub-Sahara today, you cannot not speak of the AECF, because we trusted the PAYGO models at a time when people were wondering, how will this get to work? There are challenges indeed, as you ask, Juliet, and one of them is actually relating to profitable models in respect of off-grid companies. It is really something that as the AECF many years later, some of our companies that we invested in 10 years ago are yet to get to a point where they can say we are profitable and we are able to pay the commercial investors that subsequently invested, or really be able to scale using retained earnings. I think the other thing is really that the pay-as-you-go model enables affordability for the rural poor or the peri-urban poor. But many companies will tell you they are struggling with repayment and they are having a huge debt portfolio for the reason that they understand, the solar business. They have absolutely no appreciation of, assessing, individuals and households for credit risk, and though they're happy that the product has been taken on, but later on they realize that may not really have been the type of a customer that had the ability to pay even that, $50 a day. So I think even as we have this conversation, it's really important to say, how do we over time think about the specialized model where different companies partner, and those that are exceptional in lending to the bottom of the pyramid do the financing, the consumer financing, whereas the solar companies actually continue to work on the technologies and the products and the services that would service this population. I know we are out of time.
Yes.
I share too much.
Thank you so much, Victoria. This is very rich, the rich example of Liberia. So thank you so much. And I think we will come back to that so that you can elaborate more on what you found on the ground. So I will go on to Chiara. Chiara, you were involved in the design of the Rwanda Renewable Energy Fund project, which includes a nationwide subsidy program led by the government of Rwanda, which provides end user subsidy to overcome the affordability challenges. What were the main challenges that you faced in the design of that project, and how were they overcome?
Thank you, Juliet. So maybe let me just start with giving a big overview of the REF project. So the REF project in Rwanda, a $15 million project. It's one of the first credit lines ever designed. Now there is a proliferation of those in Sub-Saharan Africa, but at that time in 2017, it was one of the first ones. It has 4 lines of credit for the off-grid companies. And then only in recent times, we decided to add a subsidy window. The credit lines leverage on all the existing financial intermediary institutions. So it's SACCOs, MFIs, commercial banks, and it also provides some direct lending. We introduced at some point $15 million window, which only provides subsidies for affordability, because we noticed that there was a stalling in the scale up of the off-grid market, and that it was due to the saturation of high-income households, and therefore a subsidy scheme was needed. Now, I think that so far, this is the second year of implementation of the subsidy, where we're seeing finally, a nice pickup in connections, but there were indeed several challenges that we had to face and fix to start really achieving some good performance of the subsidy. So the first challenge that we faced was how to use grant financing, and so how to use the subsidies. Because for us, it was very clear that it was supposed to fill the affordability gap that we had noticed in the country. But again, there were some differences in opinion, meaning that there were also an interpretation of the use of the subsidy for scaling up on lending from the credit line. So basically, off-grid solar companies would have proportionally had access to the grant financing depending on how much they were borrowing from the other windows. And this, of course, was with the overall purpose of improving the performance of the project, but that was not what the subsidies were designed for. The way that we faced this was mostly based on evidence, meaning that there was not a scale up in borrowing from the off-grid solar companies in order to access the subsidies, because they were just making their own decision on how much to borrow based on their own business plans and cash flow projections. But they were just interested in having access to the grants in order for deeper penetration of the market. So we started monitoring the market, we started collecting information, and that informed then another conversation with the government to make sure that the subsidies were accessible with no limitations of sort to the off-grid solar companies. This leads me to the other point, which is flexibility in the design of subsidy schemes as well as credit lines. Particularly for the subsidy scheme, initially, since we didn't really know how the market was going to react, we're not even 100% sure about how many companies were in the market, including the local ones. So initially, we put some caps to the amount of funding that each company could have be granted to avoid benefiting one or two companies over the other ones. But then after about a year, we noticed that at the end of the day, there were 10 to 15 companies in the market. There were actually more than we were expecting. But given that all of them had fair access to the grant financing, there was no need to limit the number and the amount of subsidy requests that each one could have put forward, which was only based, the approval of subsequent phases of the subsidy was then only based on performance and disbursements of the first part of the grant. It is extremely also important to look at the sizing of the subsidies for the households. Rwanda is an easier case because they already have a system in the country, I would say a safety net system based on the Rogate category. And that led to the definition of a progressive subsidy based on the average income of the household. This could be to some extent, I think, still replicated, of course, with a little bit more effort in other countries. But I think it is very important to, when designing a subsidy scheme, to look at the different categories of end beneficiaries that would be in need of the subsidy, to size it as much as possible, to identify, for example, if they need the subsidy because of context of poverty, fragility, and so forth. But then also have a dynamic approach to it. Social condition changes, of course, COVID showed us as much as that could be, there could be external shocks. So it is important to maintain flexibility here as well. And have, so what we're doing, for example, in order to ensure this is sort of midway impact assessment to really see what was the impact of the subsidy and then how the conditions have changed. Critical for the success of the subsidy scheme is to have a good verification in place. Usually best practice would say that IVAs, independent verification agencies, are the best solution. Sometimes the government instead wants to take it on itself. If that is the case, I think that especially from the World Bank project funded side, it is important to even provide day-to-day hand-holding and assistance to ensure that really we can keep track of the verification and adjusting course. Two more points, probably.
if we can do it.
Probably that, then I'm going to leave it to one.
Yes.
I'm going to leave it to one. So probably the biggest lesson learned, and also Charlie has touched upon it multiple times in discussing the reluctance of the commercial banks to on-lend, is the fact that some of the issues that affect the off-grid market have nothing to do with the off-grid market in itself and have nothing to do with energy. So what we thought is that in most of the cases, the lack of acceptance from the commercial banks of what off-grid solar companies can provide as collateral, it is not because a perception of risk, but because the regulation impede them to accept what the companies have as collateral, which is also something that it's suppressing not only the off-grid solar market, but it's suppressing local entrepreneurship, SMEs development to a larger extent. So this is something that I keep raising, because it also shows that we cannot, as energy specialists, we cannot solve the problem by ourselves, but it really has to be a joint effort. Thank you.
Great. Chiara, just quickly, as I mentioned before, we do not have a government representative on this panel, but we would welcome your quick thoughts on what you think this report would mean for governments and how they could use it to achieve their electrification objectives.
So I think that this report is absolutely great, because it's the first one that really provides a good structuring of the issues and of the solutions, and it does it in a very straightforward way. So it is good for different kind of audiences, which goes from government to practitioners to private sector developers themselves. So I think that it also will help governments in thinking through the issues. There is a planning aspect to it for electrification, which also means emphasizing the off-grid solar market, but there is also then a whole structuring of the different kind of support that the market needs. I think it also sheds light on, yes, maybe we can have some more mature companies, but per se, the market, it is still nascent, given the needs that we are at hand, which also leads, again, and that's the whole point of needing public support for the scale up, which also have a different range of features, going from the end user subsidies, but also on the supply side. For example, I don't think that we discuss enough and we talk enough about seed funding, potential joint ventures between an international company and a local one. And most importantly, how on the soft side, it is important to provide credit lines, access to finance and grant financing, but if this is not combined in a smart way with technical assistance, business development support to especially the local off-grid solar companies, there's only so much that we are going to be able to do. So again, I think especially the start structuring the issue in a more comprehensive way is a package way of thinking about supporting the companies and the market more in general, and really listing in a simple way, digestible way, what can be done on the demand side, on the supply side, and on the enabling environment side, really provide value.
Thank you so much, Chiara. So shifting gears, Christiane, you know, I know Bamboo Finance has experience with credit lines, guarantees, and RBF in multiple country contexts. Can you share some experience that you've had showing the benefits of supporting companies in this way and some of the risks and challenges that are involved? And in addition to that, can you give us your views on this report, how any, you know, your reflections after you read this report, what you think it will be useful for in this sector? So over to you, Christiane.
Thank you very much, Juliet, and thanks for everybody in the panel for the contributions and for the great report. But let me share a story from our program that we're running in Madagascar. And I mean, I have a lot of stories there, and there would be a nice story like that investor that approached us, saying that the OMDF program was essential for them to make the decision to invest in a startup in Madagascar, which is great. But I would love to tell a story which shows a bit more the challenges that we're facing. because it's always more interesting to talk about problems. But first, very quickly, some feedback on Madagascar. It's 28 million people, about 5 million off-grid households, very slow and small penetration of quality solar products with about 50 to 60,000 products sold per year, but still 85% penetration of mobile money across the country. And now the Off-Grid Market Development Fund, OMDF, established with a large funding program with financing coming from World Bank. There are 3 companies today that are quite established, selling pay-go companies, and a couple of more are planning to launch operations. So I would say it's an off-grid solar market in an early stage development, but with quite some potential. So after operating our RBF grant program and the credit line for a bit longer than a year, we wanted to get feedback from companies and see how they like the program and how we can improve the program to reach more households beyond the initial objectives of 300,000 connections. And we also told them that we're considering a temporary increase of RBF grants to give them a booster and also reflect the higher cost following the pandemic. All this, of course, in the context of a program that has an effective duration of 3.5 years and which is already run for a bit more than a year. We would have expected that companies in our program would, those companies that are actively selling systems already would be happy with higher grants and basically say, yes, please give us more money. We will be able to use it, sell more products because it will incentivize us to invest in more quickly into building out our distribution network, run communication campaigns, etc. So that's what I expected. But the response was very, very different. So they basically said in different variations, the following. First, they said, we will not change anything in our distribution approach if you give us a temporary boost and more grants, because we need to be prepared for the time after the grant program. With only 2 years left and then a planned phasing out of the program, we will not be able to change our strategy because of changes you make to the program now. So we felt a little bit, how you say, powerless. And the second comment that they made was, what we need is clear visibility when we receive the cash and how much of the RBF grants. Because the verification by the independent verification agent is a bit rough and it's difficult, and we see that across different geographies. So they want to see money as quickly as possible. And they need to manage their long cash conversion cycles that we heard before, and their working capital needs. So the key concern that those companies have is that verification takes too long, that the payout rates are too low, and if they are expecting and planning to receive a certain amount of grants, but are only paid a smaller amount, then they have a problem. And we have a problem because our program was designed to help those companies with a certain level of grants, but the effective grant per product sold is ultimately lower. And also, of course, we need to assume now that there's no fraud and no bad data management. So it's just a verification problem that customers couldn't be reached. And I mean, what we have actually realized is that either customers are not reached, can't be reached, they change no phone numbers, they don't respond, or they don't want to respond to the verification agent, or they provide information that is not always fully in line with the info provided by the company. But it's things like the date of the sale, which is just very different from the date that the company has given us. So. And we're trying to fix this, right? And we're working with a verification agent. But the key message here is companies need predictability and they need long-term planability. They want to know when they are actually paid, how much money, and they want to know how long a support program is going. Is it 3 years, 4 years, Is it longer term? And of course, the longer the program, the more you can influence the market with your intervention, because companies can plan. And this is particularly true for markets in an early stage, and markets where you still want to attract new companies into it. It just takes time to build a market. That's kind of what we learned. Now, do you want me already to answer to the second question that was about the report?
Yes, yeah.
I think the report is great. It really shows in a very concise manner the different intervention options and their challenges. It's very easy to read. I think it's going to help a lot in the discussion with governments, with anyone working with these type of funding mechanisms. And I could not agree more with the conclusion of the paper that you need a holistic approach. You need to combine different funding mechanisms, and you need flexibility. Otherwise, it's not going to work. So really very good report, and I'm looking forward to discussing it in more detail with colleagues and other people. What would be great in the future is that you continue that evaluation of the programs and that you basically analyze the success of those programs going forward, because I think there are more and more programs out there. There's more data, and in the next couple of years, we will be able to better assess what has actually worked and what were the most effective interventions in the different contexts. And we will also see if and what challenges markets have faced when programs end, because that's I think one of the concerns of lots of companies, because it's great to build a market and know that there's a program in place for the next 5 years. But once that program runs out, you either have reached a massive scale and you're one of the 2-3 winners in the market, or you're dead. Mm-hmm. And that's obviously a challenge.
Thank you. Thank you so much, Christian. So Emma, thanks for waiting for this length of time. But I know that the GDC represents smaller companies, many of which are locally owned or women-led. And there's always a lot of interest in making public funding available to be more inclusive. So then, we have these smaller companies. What do you think is important that public funding is accessible to smaller companies, and what needs to change to make public funding more accessible to the smaller companies?
Thanks, Juliet, and thanks everyone for having me here, and really interesting remarks from everyone else. And apologies in advance for my voice. I'm a little bit under the weather at the moment. So I think smaller companies play a very, very important role in achieving universal energy access, and that's for a number of reasons. So first of all, smaller companies tend to penetrate further into the last mile, where large companies often won't go because it's cost prohibitive. Secondly, if you've got large numbers of smaller companies, that helps to create more choice for consumers, and it creates competition in the market that doesn't exist if it's just a handful of large companies operating. And then finally, small companies do represent a sustainable way to serve last mile communities. And Victoria earlier talked about how profitability is a real challenge in the off-grid solar sector. And historically, this has absolutely been true, but I think today we're seeing more and more examples of profitable companies. But what's interesting is that profitability is not always linked to scale. Scale comes with its own problems, and what we see is that smaller companies tend to have less complex processes. Their management team can better control key functions, and teams tend to be closer to the home base in which they operate, and that makes them more nimble and more adaptable. We put out some research last year where we found that smaller and typically local distributors tend to operate lighter structures, and they focus on profitability first. And as a result, many have achieved more sales per dollar of capital raised than their larger international counterparts. So even though larger companies are selling more products, they're having to raise quite a bit more capital to do that. And there was also some research put out by Persistent last year that echoed these findings, and they found that actually the key determinant of profitability of the companies in their portfolio wasn't scale, but it was an ability to run a lean operation and adjust their model for the local operating context. So I think it's clear that we need to support smaller companies and that they are an important way to achieve impact at the last mile. But the second part of your question about how to make sure public funding mechanisms are accessible for these companies is really, really important, because we see time and time again that access to finance is by far and away the biggest challenge that small companies face. And I think other panelists have touched on some of those challenges and some of the solutions to those challenges as well. So I really agree with the success challenges, the success factors that were laid out in the report. And I think I'd emphasize above all the importance of efficient fund management. And Christian, you touched on this as well. Small companies tend to have cash runways of less than 6 months. And for those offering consumer financing, which is the vast majority, working capital cycles are long. So these companies can't wait for 6 months for funding to be dispersed. And this came to light particularly strongly during COVID, obviously, when companies needed funding yesterday, but funding just took too long to get there and companies really suffered. And it's not just about speed, it's also about streamlining and shortening application processes and reporting. And this is really important to make sure that companies can access that funding in the first place. So particularly those companies that don't necessarily speak the language of Western-centric funders, but it's also to make sure that companies don't exhaust precious resources on endless donor reporting. And in the case of results-based financing, that also extends to monitoring and verification processes, which can be very, very onerous. And some RBF facilities have provided technical assistance to help companies to navigate these processes, as Chiara talked about, and that is absolutely essential. So we've heard companies say that they wouldn't be able to access RBF without that level of support. And then finally, I just wanted to say that upfront grants are really, really important for company development. But sometimes these grants, and even really small ones, can be overly prescriptive. So it's important that funders are flexible to help companies to adapt to changing market conditions. And again, we've heard companies say that some grants that they've raised in the end just haven't been worth it because of the time investment, or indeed because it has led to mission drift. So I think a lot of this isn't rocket science. In saying that, it can be quite hard to do in practice, but if we really want to maximize the use of public funding, then we have to do more to accommodate the needs of those companies that are going to achieve impact at the last mile, and that's smaller companies. And I think this report lays that out really clearly, so well done.
Oh, thanks, Emma. Actually, you preempted a question I was going to ask, and you answered it already, and that was, which funding mechanism you thought would be more appropriate for the smaller companies. And you've mentioned the upfront grant. So really, I think that stood out to you and as one of the solutions in your particular area. You talked about smaller companies. What about, are there any peculiar challenges that women-led organizations or companies face?
Yeah, I think raising finance is definitely a challenge that felt more strongly by women-led companies, and EUP actually put out a report a couple of weeks ago highlighting the gap in capital raised by women-led companies versus male-led companies. So I think that would be the biggest challenge. And again, I think there's a lot that funders can do to make funding more accessible to women-led companies, and there's a lot of really, really good best practices out there, but it's just a matter of putting that theory into practice.
Thank you so much, Emma. Well, participants, I see that the chat, the chat is very interesting, and Charlie's been answering a lot of the questions. There were several questions, but it looks like most of them have been answered. I will just ask one question, that was posed by Eva. It says, thank you for the report presentation. It is about your view that there is no one size fits all in terms of designing the funding to support off-grid solar market, and it needs to be customized, depends on areas. My question is, how about if we would like to replicate one rural PV school in combination with a rural retail solar lantern business to support solar PV technology maintenance? Would you think it will be easier to set up a basic finance and business model that can be replicated in other areas? I think, Charlie, this comes to you. I see you are in the middle of responding to a question, but this question is for you, Charlie.
Yeah, thank you, Eva. I mean, I wouldn't pretend to be a specialist in business models, but I would emphasize that the market for public facility electrification is really very different from the market for households and for solar lights and home systems. I think there is probably the potential for synergy across the two models because both require kind of a staffing presence in rural areas and relationships of trust with the communities served. But I would just keep in mind that they really are very different business models. And so there would, for me, there would be a bit of an open question about whether it would make sense to pursue both as part of one business strategy or whether to focus on one or the other.
Thanks, Charlie. There's another question. Can you share any additional specifics about the risk mitigation mechanism, which I believe involves shared risk management between different financial actors? Practically speaking, how does that work? And how does risk get absorbed differently? And how does money get dispersed or lent by who? This question is from Jeff.
I would invite Chiara and maybe Christian to come in on this one. Chiara, I know that CEDA provided some risk mitigation to the REF, I believe. And then Christian, I wonder if maybe you can describe how risk is shared around in some of the facilities that you've been involved in. I believe you have quite kind of developed capital stacks on some of them.
Yeah, so we had associated to the REF, CEDA provided 20 million in guarantees, which covered for 50% of the collateral requirements for the end users borrowing for the purchase of a solar ground system, and up to 75% of the collateral requirements for female-headed households. In practical terms, and that it's mostly channeled either through the SACCOs or through the commercial banks. Commercial banks we discussed. Unfortunately, there's no movement there because the banks have their hands tied. So those are new regulations that need to be amended by the central bank. With respect to the SACCOs, we have seen where the regulations are a little bit more flexible given the nature of the financial intermediary. We have seen the low capacity of the SACCOs themselves in then using this guarantee. So whereas in principle it is the right risk mitigation mechanism, from the implementation perspective, it does have some challenges.
Thanks, Chiara. Christian? You have anything?
Yeah, not much to add here, and I think most of it was said before. In many markets, the risks are significant because there's little data available. And now I'm really talking about working capital financing and portfolio quality. And I'm not sure if partial guarantees will overcome that challenge because ultimately, I mean, at least for traditional lenders, it doesn't change the fact that they would be in the money and would need to assume a risk that they're not able to assess and price. So basically, I think you need these type of credit lines, right? That as a support mechanism that are able to take a bit more of a risk here. And we talked about that on the collateral side, except the solar products and the customer receivables that don't request personal guarantees because that's often either not available or an issue for the promoters and the companies. You might be able to increase loan to value, etc., but ultimately, and by that take additional risk here. But ultimately, you need I think in early markets, you need those type of programs assume that early market risk, help companies build out a track record. And then obviously you have to try to bring on board more traditional lenders, but that takes a long time. I think going back to Madagascar, I think it's an interesting example because in Madagascar, the program was designed by the government of Madagascar and World Bank to include that credit line, but request the fund manager that was selected to manage the whole market development fund to team up with a local bank to actually provide the lending, the credit lines, because of regulatory reasons that you need to have a banking license to provide loans. But that was, I think, a very smart move because in our case, we teamed up with Société Générale. We have a great team from Société Générale on the ground who knows the market very well, who knows many of the companies, or at least their investors and shareholders, who helps a lot with, I guess, of course, with the back office and other things, but with understanding some local risks here, without having their own risk here, because the credit line is fully de-risked by the program for Société Générale. But it helps them to progressively better understand the sector. And I think potentially Société Générale will be one of the first banks who will be able to continue lending to that sector once our program runs out. So that's I think a smart idea of involving private sector banks in all of this, because you combine their experience with the experience of fund manager in the solar market sector, off-grid sector, and help them assess those opportunities and understand the risks and build that expertise in-house. I know that I deviated slightly from the original question, but I thought that was a good idea of developing a framework to better assess risks and ultimately share them.
Sure. Thank you so much, Christian. Victoria, I'd like to come back to you. I know the AECF is a leading provider in upfront grants. I wanted you to reflect on, or to share with us, in what circumstances you think that they are better than RBF or a credit line or any of the other funding mechanisms that are in the report.
Thank you, Juliet. And really, my answer would totally align with what was in the report, which is really in the circumstances where you're looking at highly innovative but risky business models that are yet to be tested in the market, yet really present a great potential for impact. And so you get to use this to be able to serve the world with the future unicorns. It's like saying, what are the next generation of off-grid technologies? And we then use grants to be able to surface those and be able to give an opportunity to the entrepreneurs, to the businesses, to be able to take that to the market. And then, of course, the other one really is, incentivizing private sector to go to places that they otherwise wouldn't go. And so when you look at markets, for example, like Liberia, that I mentioned, or Somalia, where we work, you want a tested model that has actually worked in another market that really could be able to be replicated to actually, move in that manner. And it is very difficult oftentimes for mature companies to want to take that risk. They would prefer to go to environments or places where the enabling environment is that which already is supportive, or is assuring of financial returns. So I think in that instance, actually incentivizing and risk sharing with them to go into these particular markets would be a good use for grant funding. And I just want to go quickly back to the challenges relating to grant funding, because I thought I addressed it from the challenges that I see in our portfolio, but not necessarily in respect of the mechanism itself. But I think all of us know just the issue of distortion, that as in it's been seen over and over that it is very possible that grant financing could really distort the market. And then we could also have a generation of grantpreneurs, people who want to use grant money, not so much because they really can't access other types of capital, but for the reason that they know to be able to pitch for grant funding. I think the other issue is really around the picking of winners, but I think for us at the AECF, we say, what about if we look at it from the position of we are starting races and we are leveling the playing field, for the reason that these particular small medium enterprises really continually are excluded by mainstream financials.
Thank you so much, Victoria. And Charlie, I want to thank you because most of all the questions are gone. You've answered all the questions in the chat. So I think this has been very, very efficient. And Charlie, if you can put up the slide which shows the contact information so that people can be reminded of what to do if they have more questions. But I want to thank the panel. This has been a very interesting discussion. I know that, from what the questions that have come out and this, your contribution, this report needs to be unpacked further. And this discussion will go further in different fora, and, we'll break it down and get a lot of people to understand more of what the funding mechanisms are, how they can use it, and what conditions, conditions need to be in place that for the, that selected funding mechanism to work. And as Christian said, we need to do, an assessment after the project has been completed. What happens when the funding goes away? How can it be, do the companies still, stay alive or they just die? What happens when we have local companies in the market? I don't know, in Chiara's case in Rwanda, I'm not sure, you said you had more companies applied than you expected. Were they more local companies or international companies? And what we need to put in place to bring that right mix of funding mechanisms in place that would advance the energy access agenda. So I want to thank you so much for your participation in this forum. And thank you, participants, for your questions and participation. This report is going to be published in the next couple of days, and it will be emailed to all the webinar attendees, in addition to being published online and being promoted through LinkedIn and other social media. Really, I don't know, somehow I don't see the contact information, but comments, additional contributions can be put into, can be submitted to Charlie or sent to either me or anybody in the bank. And we will make sure that your questions are answered. And one other thing is that we are surely going to be, putting this report out there, and we would really covet your comments, your inputs, suggestions to either go to the next step that this report will, open up for us, or different things that we didn't even look at. But so far, this is the first report, and I am sure there'll be many more that will address the burning questions and challenges that our esteemed panelists have presented based on their real life experience. So thank you once again for participating in this webinar. And we look forward to you participating in our other webinars, the End User Subsidy Lab. We have various webinars. So please look out for our various webinars and attend. So thank you once again, panelists, Emma, Christian, Victoria, Chiara, and thank you most of all, Charlie, for presenting this, and my colleagues, Joe, and everybody who helped with the logistics. Thank you so much. So Enjoy the rest of your day, and I look forward to seeing you at another webinar. Thanks.
Thank you, Juliet. Thank you, Charlie. Thank you, everybody.
Thank you.
Thank you.
Thank you. Bye-bye.